Imagine this. You take a trade, everything looks perfect. Price starts moving in your favor, and suddenly you get stopped out. But the worst part? Right after that, price goes exactly where you expected. If this has ever happened to you, don't worry, it's not random. Today I'm going to show you why this happens and how to stop being the one who gets caught. Let's start with something important. Big players like banks, institutions, and hedge funds can't just click buy or sell like we do, because if they place huge orders, they would move the price against themselves. So what do? They need to find a lot of orders in the market to fill theirs. And where are those orders? In traders' stop losses. Liquidity is simple. It's stop losses, pending orders, and breakout entries. Anything waiting in the market to be triggered. And where is liquidity? Very simple. Above highs and below lows. Always. Why? Because that's where most traders place their stops or enter trades. Here's the uncomfortable truth. If you can't see the liquidity, you are the liquidity. Now let's break down the main types. First, session highs and lows. Each session, Asia, London, New York, brings new money into the market. That's why price often goes back to those levels. Second, double tops and double bottoms. What most people think is a signal is often a trap because there are a lot of orders sitting there. Third, trends. Every low in an uptrend has stop losses below it. If you see multiple lows close together, that's stacked liquidity. Fourth, internal versus external liquidity. Internal liquidity is inside the range. External liquidity is outside the range, and that's the real target. Price uses internal liquidity to reach external liquidity. Now, the key concept, inducement. This is where most traders get trapped. The market shows you what looks like a good opportunity, but it's actually bait. It makes you enter too early. Here's a simple example. You see a double top, so you go short, but there's still liquidity above. So price goes up, stops you out, and then drops exactly as you expected. You weren't wrong, you were just early. Here's the key rule. Before price moves down, it will usually take liquidity above first, and the same works in reverse. So how do you avoid this? Don't enter just because price hits a level. Wait for confirmation. What is confirmation? Keep it simple, a shift in structure. For example, price was going up and now it starts going down, or it breaks a key low. That tells you liquidity has been taken and the real move is starting. Now let's talk about timing, because timing is everything. You can have the perfect idea, but if your timing is off, you lose. The best trading times are the London Open, the New York Open, and the London-New York overlap. That's when real volume enters the market. The Asian session, slow, quiet, no clear direction. Not the best time to trade. So remember this simple formula. Liquidity tells you where, timing tells you when. You need both. Here's the step-by-step process. Step 1, identify the market direction. Step 2, mark all liquidity areas. Step 3, define the range. Step 4, check if there's still liquidity waiting. Step 5, wait for the active session. Step 6, watch price sweep liquidity. Step 7, enter only after confirmation. And where do you take profit? Simple, at the next liquidity zone, because that's where price is likely to react.